emerging market, obviously, it's a very big topic, and usually when we talk about emerging market, a lot of people think about sovereigns, about corporates, and this is what I would like to do today. Focus really on hard currency and try to move from sovereigns into corporates. I think over the last 25 years, I mean, this market has grown, and today when we look at EM corporates, we could also see that this is actually a 2 trillion market cap. It's even larger than the entire US high yield market, and together with sovereign bonds, it will be even larger than the entire Eurobond market. So when we distinguish between sovereigns and corporates, very quickly, what we realize is that when we look into the different yield components, we have more or less the similar yields, slightly longer on sovereigns. This is also because of the rating composition as well. Corporates is more like an investment grade, even though a lot of people have historically looked at this asset class more like a high yield, but we talk about this in a moment. But obviously there is a big duration element, when we talk on sovereigns, and it's actually quite surprising that when you look at sovereign bonds in emerging market, your duration is over 8 years, which means you are actually exposed to treasury move and quite a lot of volatility in this sense. Obviously corporates, it's able to reduce that volatility quite a bit, below 5 years, and you have a nice pickup. But let's move maybe to the next slide, because actually when we look into the risk return profile, what we can find is that over time, what you see is that corporates, they tend to have a better performance, with less volatility, and this is also because of the on page 5, exactly this, and this is because of the volatility that investment grade and especially sovereigns have, versus corporates. I think you can really see it in the next slide, if we can move to the next one, because when you look at actually the composition, what you realize is that emerging market sovereigns typically has a lot of duration risk, because the high rated or the higher quality countries, they tend to issue very long data bonds, because the short maturities they can very easily do in their home markets in local currency. And basically the composition of high yield in sovereigns is typically more high risk. The default rate last year on that particular area was over 15%. So this is why you have a higher allocation in single Bs, whereas in corporate you are more diversified. Also when you look at countries and regions, you could see that actually sovereigns, they tend to have a more exposure to certain countries, which obviously in the past few years have been a bit more volatile or more in demand of dollar funding. I think on the next slide, maybe if we move maybe to the market, and where we see value today in the corporate universe. Clearly, when I look at the yield and basically the level or rating risk that you need to take to achieve those returns, one can actually see on page 7 that you actually take less rating risk, with higher yield. And whether you look into government bonds, you look at different regions, I think it's a very attractive proposition versus developed markets. And this is where we're moving now. I think what we actually see is that investors are looking for yield, they're demanding for yield, and they actually look for opportunities to enhance that yield portfolio without taking too much duration risk or credit risk. In page 8, what you could actually see now is the difference between if I just look at the investment grade in emerging markets and we compare it to the US, you actually see quite a nice pickup. Today, if you buy a US investment grade portfolio, you have a yield of around 1.9%. If I look at indices, that gives you around 100 basis points, and and you have a 8-year duration. So here you actually can have 3%, you have a nice pickup, and you actually reduce duration by 3 years. Moving into the next slide. Credit Suisse obviously has been focusing on emerging market for a very long time. I think our track record is over 15 years in this area. We have a full range of corporate solutions with superior returns. And I would like to maybe introduce you in page 10 to our investment grade corporate bond fund. This is a strategy that it's actually been very well received among the investors like you, because it only invests in investment grade, but at the same time, it's able to achieve a higher yield with shorter duration. Currently, in our portfolio, we have a duration of 2.35. By the way, this is in US dollar. So, of course, if we hedge this into euro, and given the short hedge cost that you have today, you get a yield in euros of 1.5 with a duration of 5 years. Just to give you an idea, if you buy today Euro corporates, triple Bs, you get a yield in Europe of 0.4%. So this is nice to pick up. It has over 9 or 10 years of track record. It's over 2 billion fund, and it's well diversified. In the next slide, this is the EN Corporate Bond Fund. Again, this is our flagship fund. It invests obviously between investment grade and high yield, over 2 billion size. This is a fund that since inception has generated a 7.5 annualized returns. Both strategies are 5 morning stars, and in the last slide you can see that over the time period we've been able to beat our peers, in almost every year. And with that, I'll conclude my part, and thank you for your participation.